1. What is the illusion of control? The illusion of control is the tendency for people to believe they have control over events that are actually driven by randomness or external factors. This concept was first defined by psychologist Ellen Langer. According to Langer, people tend to think they have influence even over events they cannot truly control. In simple terms, acting as if we have influence over something that is not actually under our control is the illusion of control. 2. Why is the illusion of control important in investing? Investment decisions often involve uncertainty. Markets fluctuate. News affects prices. Other investors' behavior may be random. If an investor falls into the illusion of control, poor decisions, excessive risk-taking, overtrading, irrational behavior may occur. For this reason, the illusion of control is considered one of the most dangerous traps in financial psychology. 3. How does the illusion of control work? The human brain looks for patterns to cope with uncertainty. This leads to framing random events into meaningful narratives, viewing outcomes as if they resulted from one's own actions, overestimating the importance of simple strategies. 3.1 Psychological Foundations. The illusion of control mainly arises from perceived self-efficacy. I am successful, so the outcome must be related to me. Hindsight bias. Thinking, I knew it all along. Illusory pattern recognition. Seeing misleading cause and effect relationships. 4. How the illusion of control appears in investing. 4.1 Overtrading. An investor believes they can control market movements, constantly opens new positions. This behavior often leads to poor returns and higher costs. 4.2 Overconfidence in short-term price predictions. Assuming the market can consistently be predicted in the short term. However, in the short run, markets often behave randomly. 4.3 Attributing success to skill. Attributing a lucky profitable position to personal strategy or skill. 4.4 Believing losses can be controlled. Taking greater risks to recover realized losses. When combined with classic loss aversion, this can lead to significant damage. 5. Academic and scientific findings. The illusion of control experiment. In Langer's experiments, people believe they influenced outcomes even in purely chance-based events such as rolling dice. These studies demonstrated that humans are naturally prone to the illusion of control. Research in finance. Behavioral finance studies show that inexperienced investors are more prone to the illusion of control. Even experienced investors can fall into the illusion during highly volatile markets. Overconfidence illusion of control poor decision cycle. This cycle negatively affects investment performance. 6. Harmful consequences of the illusion of control. 6.1 Excessive risk-taking. The investor behaves as if markets are controllable high leverage, oversized positions. 6.2 Extending losses. When a position is losing, I'll wait a little longer. In reality, there is no guarantee of reversal. This reflects believing one can control something that is not controllable. 6.3 Overtrading plus high costs. Every trade brings commissions, spreads, and taxes. The illusion of control leads to more trades, higher costs, lower net returns. 7. Typical statements reflecting the illusion of control. I can accurately predict the market trend. Signal-to-noise ratio is high. Predictions are uncertain. This time will be different. Past performance does not guarantee future results. I always win. This is just a small fluctuation. Selective perception trap. The more I trade, the more I earn. Transaction costs reduce net returns. 8. How to reduce the illusion of control. 8.1 Conscious awareness. Being aware of behavioral traps strengthens investors. To achieve this, keep an investment journal. Perform cause and effect analysis after each trade. Note emotional decisions. 8.2 Structured strategy plus rules. Create an investment plan including entry conditions, exit conditions, risk limits, position sizing. A structured plan reduces intuitive, illusion-driven decisions. 8.3 Risk management. Portfolio diversification and position size limits help prevent the illusion of control. 8.4 Data-driven approach. To understand random market movements. Use statistical analysis. Make decisions based on data. 9. The illusion of control and psychological factors. Overconfidence. Self-confidence combined with the illusion of control leads to excessive risk-taking. Fear of loss. Investors take riskier actions to recover losses. Confirmation bias. Focusing only on information that supports one's own view. 10. Example scenario. The stock market has been rising recently. This trend will continue. This thought reflects the illusion of control. Believing one can control or predict the market's future. Realistic analysis. Past performance does not predict the future. Trends can reverse. Emotional decisions are risky. 11. Why are some investors more prone to the illusion of control? Inexperience. Emotional investing. Short-term focus. Overconfidence. Excessive exposure to social media and speculative content. 12. Summary. Why is the illusion of control dangerous? Effects on investment performance. Overtrading. High costs. Increased risk. Weak decision discipline. Emotional decisions. Therefore, it is crucial to limit control to the areas that truly can be managed. Plan. System. Discipline. Data-driven decisions. 13. Conclusion. The illusion of control is one of the most common cognitive biases in investing and leads to many poor investment behaviors. However, through awareness, objective analysis, disciplined strategy, and effective risk management, this bias can be reduced.